A major decoupling is surfacing in the macro landscape. While oil prices hold stubbornly above $100, treasury yields are starting to collapse. The bond market is flashing what Eurodollar University describes as a massive warning signal. We're seeing a sharp yield reversal in 2-year and 10-year treasuries, with yields dropping despite the current energy shock. This technical shift is our lead catalyst today, appearing alongside extreme sentiment levels that we rarely see without a much larger drop in the major indexes. While the technical signals are loud, investor sentiment is screaming. The Fear and Greed Index has collapsed to a reading of 9, a level of extreme fear rarely seen without a much larger drop in the major indexes. At the same time, geopolitical headlines are also in focus, with potential strikes on Iranian oil infrastructure if key shipping straits remain closed. Analyzing the bond market's verdict, Eurodollar University argues that energy shocks aren't just inflationary, they're a recessionary tax. The thesis is that high prices lead to demand destruction, where a cooling economy eventually forces oil prices back down. This is why yields are sliding. Investors are pricing in a slowdown that effectively calls the Fed's bluff on sustained inflation. Supporting this shift, 5-year forward inflation expectations have hit a multi-year low of just 206 basis points. It's a sign of significant inflation complacency, even with oil at these levels. Eurodollar University notes that the market is effectively calling the Fed's bluff, viewing current energy spikes as a catalyst for a hard landing, rather than a permanent pricing spiral. On the sentiment front, we're seeing what looks like true capitulation. Nana points out that the Fear and Greed Index has hit a 9, reflecting a level of panic that vastly outpaces the actual price action. This hedging panic is visible in the options market too. Joseph Carlson notes that SPY put volume has crossed 8 million contracts, a level that has historically preceded significant market rebounds. Technically, the market is hitting what the compound calls a 2 sigma oversold floor at 6,250. This level is a key statistical anchor, carrying a 92% historical win rate for subsequent rallies. It underscores a sharp disconnect. Even as macro headlines deteriorate, the data is reaching the type of extremes that often signal a durable bottom. Structural shifts are coming into focus as AI begins to disrupt traditional professional roles. Invest with Sven Carlin points to a 56% drawdown in FactSet, a signal that Wall Street layoffs and the commoditization of data are putting the legacy terminal subscription model at risk. Rather than simple job loss, the Hoover Institution points to a major labor migration. They expect AI adoption to spark massive demand in the energy sector to build out new power infrastructure. At the same time, we're seeing an increased need for legal experts to navigate the new regulatory frameworks around these systems. Essentially, human capital is shifting out of traditional professional services and into the physical and legal backbones of the AI economy. Shifting to our signal sweep, liquidity is resurfacing as a primary concern. Eurodollar University notes that foreign reserve assets at the New York Fed have dropped by over $100 billion since February, a signal of dollar scarcity that now exceeds the 2023 banking crisis. At the same time, capital allocators is flagging systemic risks in the credit markets, specifically pointing to liquidity mismatches in private credit interval funds. Moving past those credit risks, Joseph Carlson observes that tech-forward multiples have compressed to 21 times, even as analysts continue to raise earnings estimates. Regarding the central bank, Nana reports that Chair Powell views the current energy conflicts as transient. The Fed is expected to wait for a clear impact on long-term expectations before considering any policy shift. Benjamin Cowan points to an April window for a potential durable low following a total drawdown of 10 to 15%. Meanwhile, the compound suggests energy stocks remain a mandatory hedge, noting the sector's high dividend discipline compared to tech's uncertain AI spending. To spot the turn, watch for the S&P 500 to hold support near 6,250 and for oil to stay flat for a full week. These markers could signal the transition from panic back to a more tactical environment. The bond market's warning signals a transition into a new phase of the 2026 cycle. With technical floors being tested this week, maintaining strict discipline on valuations remains essential. For the full source list and detailed charts, check the links in the description and subscribe for more high-signal market recaps.